Well, happy Friday, options traders. Welcome, everyone. And I hope everybody's off to a good start for Friday. And I thought it would be fun to throw out a little bit of a math question for the group and ask, how much faster do short-term options decay? It's an important question because too many times new traders are tempted to buy the short-term options because they think they're limiting risk. The option's cheap, and they just don't realize how much faster these options decay. So it's a good question. What do you think? How much faster do short-term options decay? Well, to answer, we have to back up to some of the basic time decay properties. Remember, option prices don't decay in a straight line. And what that means is that a 30-day option, for example, trading for $3, doesn't lose 10 cents each and every day. That's what we would call a linear time decay rate. And options don't work that way. Instead, it decays slowly at first, but then they will speed up. And it turns out they are priced according to the square root of time. I know, nobody wants to talk about square roots, but if you want to understand just how much faster short-term options decay, we got to talk about it. So here's the way that the square root pricing rule works. Let's say that a 1-month option is trading for $1, and most traders would think that the 4-month option should be trading for 4, because you've got 4 times the amount of time and therefore 4 times the price. And that is not how they work. Here's the way that you figure it out. Notice that we have 4 times the amount of time between the first and second options here. So we take this number 4, take the square root of that, and we get 2. So this number here in green becomes our multiplier. That tells me that I take my first option multiplied by 2, and that's going to give me the expected price of this 4-month option. So think about it. The 1-month option is $1. You can go out to the 4-month option before you'd see it trading for 2. So it turns out that it takes about 4 times the amount of time to double an option's price. And this means it becomes a better and better deal for the buyers to buy time and a worse and worse deal for the sellers. Sellers want to sell the shorter dated ones, but what you'll find is that people do the opposite. Now it turns out we can also work this relationship in reverse. If we're looking at a 4-month option and we want to know how much less the 1-month option should be. Well, notice that this first option is 25% of the time. So we just say 0.25, take the square root of that, and we get a half. So that tells me that moving from the second to the first, I would have to cut this price in half. So if the 4-month option is trading for 2, the 1-month should be trading for 1, roughly speaking. Now, if they're not exactly like this in the real world, it's because of skews. And this can be a very good way to kind of at least shed some light on where some of the opportunities would be for things like calendar and diagonal spreads. But again, traders are tempted to buy the short-term options and they want to sell the long-term. Because again, they want to buy these short-term options because they're cheap. They want to sell the long-dated options because they think they're getting in a lot of money. But they don't realize that on a per-day basis, they're doing exactly the opposite. So go back to our prices here. If the 1-month option is trading for $1, 4-month option trading for 2, if you sell the 4-month option, let's say for a covered call, yes, you'll collect 2. But I'm going to sell the 1-month option 4 times. So I'm still going to take 4 months to carry this out, but I'm going to get $4 instead of 2. Twice as much money. On the flip side, if you buy the 1-month option 4 times, it's going to cost you $4, whereas you could have just bought the 4-month option for 2. Cut your cost in half. So again, this shows why it's better for the option buyers to buy longer dated options and for the option sellers to sell the shorter dated. So now that you have the basic idea of the pricing relationship, let's answer the main question of this video. What is the cost of short-term options? How much faster do they decay? Well, time decay works in the opposite direction of price. The 1-month option is going to have about 2 times the rate of decay of the 4-month. The 1-month option will decay at about 3 times the rate of the 9-month. And the 1-month option will decay at about 4 times the rate of the 16-month. And the way that I'm figuring that out, again, is just taking these square roots. Square root of 4 is 2. I know therefore that the 1-month option is going to decay at twice the rate. Or I could say that the 4-month is going to decay at half the rate. The 9-month option will decay at 1/3 the rate because the square root of 9 is 3. Square root of 16 is 4. So you can see that if you're choosing the shorter dated options as opposed to the longer dated ones, your time decay greatly accelerates. If you think that time decay is already difficult enough, try multiplying it by 2 or 3 or 4. They're massively different. So remember, if time decay is a concern, don't be afraid to buy time. All right, let's see if this actually holds in a pricing model. I've got 30 days to expiration, and it's telling us that my theta over here is 0.0571, about 6 cents. Now watch this. We're going to increase the days to expiration from 30 to 120. That's a factor of 4. What happened to my theta? Now it drops to 0.0285. And notice that this first number here is 2 times that of the second one. That's saying that the shorter dated option is going to decay at twice the rate of the 120-day option. Let's try another one. We've got the 30-day option again. The theta is 0.0571. What if we increase the time to expiration by a factor of 9? We're going to look at the 270-day option. Its theta is 0.0189. And because of the square root pricing rule, we should know that the shorter dated theta is going to be 3 times that of this one. So 0.0571 divided by 0.0189 is about a factor of 3. So if you're choosing the 30-day option over the 270-day option, your theta is about 3 times as fast. So as I always tell traders, it's not saying that any of these choices are right or wrong or good or bad. They're just tools. But where they become a danger is when you're making decisions for the wrong reasons. If you think that the short-term options are less risky or that they have less money to decay and you think that you're somehow safer, that's where it becomes a problem. So I hope this helps you to understand a little bit more about the square root pricing relationship and just how much faster short-term options decay compared to longer dated ones. If you'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsatoz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.